Good morning. Let's start making our way to our tables. We're going to get started shortly. Well, good morning. Welcome to the February meeting of the North County Estate Planning Council, San Diego. Happy New Year for those that I hadn't seen previously, but glad you all could make it. We're thrilled to have a great presentation today by our local RIA folks, kind of the state of the economy, the investment world, and so on and so forth. But we'll do an introduction to them shortly. Obviously, you found your way to our new venue. Loma Santa Fe is very accommodating and helpful. Couldn't be better serving folks. So when we have our social events, we have that out here. Beautiful locale, and we're planning one sometime in this quarter. Obviously, we're still dealing with both in person, and glad we got a pretty good crowd here today, along with our Zoom folks. Hello, Zoom folks, but thrilled to have you. Just a couple of announcements. We've got our upcoming meetings. Just real quickly go through those. On March 1st, 2022, always the first Tuesday of the month, we've got Jenny Bratt and Sarah Pike of Withersbergman, who are going to present on tabloids and taxes, a recap and deep dive of recent news regarding tax planning for the wealthy, and a review of the current status of tax law impacting high net worth individuals. We were certainly thinking that we might have a review of Biden tax proposals that had passed, but that doesn't appear to be happening. So Jenny and Sarah are going to give you an update, at least as of March 1st, with some of the possibilities. Our sponsor for that meeting is Paul Hines, now with Aspirient. Paul's firm, Hearthstone Private Wealth Management, recently merged into Aspirient. So we're thrilled to have Paul sponsoring that presentation. I want to introduce to you now Buddy Thomas of Superior Planning. He's going to be presenting on some background on what Superior Planning brings to the table. Buddy?
Thank you. I love this group. I don't know of a group that does more for families and family wealth at this level and at this level of sophistication than anywhere else. Can you hear me now? Okay, I just wanted to tell you I love you guys. Thank you, Bill. Good morning, everybody. I just will go as fast as I can to give you an idea how you or your clients might fit with us. Everything you're going to see on the slideshow, except for the little teeny case study, is on our website. We've got about 200 very short videos because this family wealth is a very sophisticated thing. So what we did is we broke it down into 1 and 2 minute segments. And we've been sending those out now for about 3 or 4 years, and they're really popular because people if they're thinking about something, it gives them some more to think about and get involved. It's all about beginning with the end in mind and the big picture. It's difficult to present the simple beyond the complex, but that's what we do. Most families just want to do no harm, right? They want to do no harm and they want to make their money last. And they hope that that next generation can pick up the ball where they left it and take it to wherever they can possibly take it. So what we do is we try to put all the information they need to make a decision on one simple graphic format and make informed decisions. And it's been working for us for 40 years. Go ahead. As family wealth grows, the needs get greater. And this is kind of what we saw as the evolution of people. They start doing it themselves and then they get some financial planning, wealth management, get the private banking, and very few of them have family office. And that's kind of the role we fit. We're like a plug and play family office. But the people that get into this kind of planning are usually have a stewardship mentality. It's not about them. They want to do more, as I said, they want to do more good than harm. They want to put in the time and effort. And what we decided is that what we've seen is that they have two fiduciary roles. They usually have a trust, so they have the legal fiduciary role, but they also have a moral and an ethical role, fiduciary role to their family. And we've coined that kind of a family fiduciary. So those are the clients that we all work with together, and they're looking to us for direction. But what happens is it gets complicated. And they know what the big picture is, and each of us know what our specialty is, but it's really difficult to coordinate it all. They know how to make money, but they don't really know what to do with it all after they make it. And they really don't know who to trust, so they pick one of us, usually, or maybe two of us, and then they look for guidance from us. They can see the big picture, but as specialists, a lot of us are restricted to just, seeing our piece of the pie. And it's really hard for them to make decisions. And a lot of times plans don't move forward because they get bogged down in this complexity. So the way the family office works is it fits between the family dynamics and the family money. And the clients don't realize that it is possible to step back and look at this big picture. I mean, I didn't realize it when I started. And then as I got into it and I saw this same problem with a number of families, that's how we developed the firm that as we do it now. And we actually used it for my own family back in 1982. We transitioned between generations. So they're looking for guidance on what to do, how to do it. They're not aware that you can balance it. They're looking for a practical format that doesn't bog them down. And one attorney that we work with wouldn't even do an advance estate plan until we at least introduce them to us so that we can give them an idea of what the whole picture looks like. So this is a simple graphic. This is part of our proprietary process called the super plan. And this works with any level of sophistication with the family. What we do is we draw a line on a paper. Your estate is above the line. That's the current estate. It's going to be taxed. The estate below the line, the part below the line isn't. This was we gave this presentation last week to a family who had, they were in an estate tax situation where they had a couple $1 million worth of estate tax. And they wanted to know what to do about it. But I wanted to tell them all about a digit and an LLC. But if you get into that kind of stuff, that could take a while. So what we just did is we said, here you are now. You bought a life insurance policy. It's in an ILET, and everything's going to go out right to your kids, and there'll be enough money to pay the tax. Pretty simple plan. But they wanted to go to the next level. So go ahead. So what we did is we introduced it was a digit with an LLC inside of it, but we call it the family bank rather than getting into technical terms, and then 3 separate property trusts for each one of the children. And we eliminated the estate tax by doing that and selling some of the assets back to the, we sold some of the business assets. The digit bought them out for a self-canceling note. So this is a pretty sophisticated plan, but we sat down, we talked about it for maybe an hour and a half. The attorney was in the room. We collaborated on it beforehand. And when we presented it, I mean, the husband and wife both understood it. They said, I like it, let's do it. And he's an engineer. So when we get into the weeds, I know it's not going to be as easy as it is, but they already bought into it emotionally and they know what they want to do. So there's barriers to doing these kind of planning, and it's usually because they have momentum. Most everybody thinks their plan's okay, and thinks it's maybe they want to believe it's too much work, right? Because they don't really want to change, but how's that go? Everybody wants to go to heaven. Nobody wants to die. So they look at it as maybe too cumbersome, and they'll look for reasons not to go ahead and do and implement the planning, and the typical procrastination. But the motivators are you. I mean, most of them, or that I've seen, move because somebody they trust say, hey, you got to do something about this. So that's one of them. But then there's also life events. We had a client come to us who had ALS, knew he had 3 years to live, really wanted to set his spouse up who really had no idea how to handle their wealth. So we used those 3 years before he passed away to get her ready to go. And a lot of times a major liquidity event, selling a company or something, or a pressing tax issue or tax law change. As you know, when the tax laws change, they all get all fired up and they come in and they want to do something about it. But whatever it is, it's up to us to help them get over the line and move forward. So we use our proprietary process. It's called the Super Plan, and it's customizable for each client, balances family dynamics along with the family money. This is what we've been doing for 40 years. It's our primary business. We have a sense of what works and what'll get through and what doesn't, and how to help people move the ball down the field. So whether your client's fit for us or not, we're usually up above the $15, $20 million range. If they fit for us, we'd love to talk to you about how we might be able to help. But if they don't, please consider us a resource. Thank you very much for your time and attention.
Buddy, thanks so very much, and really appreciate Buddy and his support for the council over the years. Just real quickly, for those of you that have been asking, the Wi-Fi password for here is Lomas Wi-Fi, all small. And without any further ado, I want to introduce Katie Swafford. Our Hot Topic ladies are back in gear, and Katie's going to give us an update on kind of current developments. And there's a handout at the desk if you didn't pick that up. Thanks, Katie.
Hi, everyone. It's great to be back. I don't know if you remember, but before the pandemic, there were three of us that used to spend about 5 minutes at the beginning of each meeting talking about hot topics. And we stopped doing that during the pandemic. Just it was logistically hard to coordinate all these different people on Zoom. But now that we're back in person, hot topics are back. So the hot topic that I'm going to talk to you about today, just very briefly for about 5 minutes, are conservatorships. So you probably have heard in the news in the last year about Britney Spears being in a conservatorship. And so this is a very hot topic, current development in the state of California. We have new conservatorship laws. Last fall, Governor Newsom signed AB 1194. The bill is 33 pages long, so I can't possibly talk about all of it in 5 minutes today. So I'm just going to highlight a couple of the important points. But basically, this legislation was signed in direct response to the Free Britney movement and what was happening with her conservatorship. And it's not perfect. There's been a lot of criticism of the bill. There's some good things, there's some bad things. My sense is that this is probably a start, and we're going to be getting more and more modifications to the conservatorship laws in the coming years. But nonetheless, it is the law now. So we have to follow it. And there are some good aspects of it. And so one of the aspects that I like about it that I want to talk about today has to do with the proposed conservatees or conservatees retention of counsel. So you may recall that Britney was put in a conservatorship all those years ago, I think like 13 years ago. And what happens is when you file for conservatorship, The court automatically appoints an attorney to represent the proposed conservatee. The courts keep these lists of attorneys that are on this panel. And basically it's sort of automatic, generated by the computers. As the moment the conservatorship petition is filed, something in the system goes off, and the court automatically appoints an attorney off the list to represent the proposed conservatee. And in some cases, this is really helpful because you have a lot of conservatees who don't have the financial resources to hire their own counsel. That's really the purpose of it, is to make sure that everybody has an attorney to represent them in this type of proceeding, because a conservatorship is a deprivation of your most basic of liberties. You basically are putting someone else in charge of your personal needs and your financial affairs. But there are situations from time to time where we have conservatees that do have significant resources of their own, and they want to be able to hire their own attorney. Certainly someone of Britney Spears' caliber, she's she's high profile and she has lots of money. She should be able to hire her own attorney, but that's not what happened in that case. And as I haven't studied her case, and nor do I have any desire to, 13 years of filings or whatever it is. But from what I understand, she was appointed an attorney automatically, and she could never get out of that relationship until last year, when this all kind of came to fruition and the movement got started. And I know there was at least one point she told her attorney that she wanted, or she met with a very high profile outside probate litigator, and asked the court, that attorney went into court to asked the judge to be appointed, and the judge refused to appoint that attorney, claiming that she didn't have capacity. So here's this really wealthy woman that's not even able to hire her own high profile attorney to represent her, and she's stuck with an attorney off the court appointed list. Now, I'm sure the attorney is a very nice person and a good attorney, but for someone like her, you would think she would be able to hire her own counsel. Anyways, the new legislation changes things. So basically, if you have a situation where a proposed conservatee like Britney Spears is able to express a preference for an attorney that they want to hire, the court has to allow that attorney to be hired now and to discharge court-appointed counsel. So if this law would have been in place during Britney Spears' conservatorship, all she had to do was say, hey, I want to hire this person, and the judge would have had to accept it. So we hopefully no longer will have this situation where someone like her or anyone else that's in conservatorship litigation is stuck being represented by someone that they don't want to be represented by. They should be able to hire their own attorney. So another important update is the attorneys for proposed conservatees are now required to be zealous advocates. That's the language used in the statute. And you probably say to yourself, well, why is this even out there? An attorney is supposed to be always an advocate on behalf of their client. Yeah, that's the way we do things in San Diego. I'm on the court appointed list in San Diego, and the rule has always been, we are advocates for our clients. If our clients tell us to object to a conservatorship, we have to do that. We follow their instructions and directions, but different counties do things differently, or at least they did before the new legislation. And as I understand, in LA was not using the advocate approach, so to say. They were using more of a best interest approach. So if someone like Britney was, telling her attorney, I don't want to be in a conservatorship, but the attorney thinks that she should be in one, he's gonna do what he thinks is in her best interest, not what she's actually telling him to do. And it's just kind of a perverse situation, because normally, like I said, attorneys are supposed to be advocates for their clients and follow their instructions and directions. So now we have a law in place saying that San Diego was doing things right all along. And, throughout California, attorneys are always supposed to be zealous advocates for their clients. So another important update has to do with court investigators. When a conservatorship petition is filed, there are investigators that are employed by the court, and they are always supposed to go out and see the proposed conservatee. And sometimes this wasn't happening. or when it was happening, they weren't doing enough. And so now the new laws say that the investigators have to do very thorough reports and interview not just the proposed conservatee, but relatives, friends, neighbors, doctors. Basically, the purpose is to have a very full, comprehensive report for the court by someone who's independent. Whereas, the attorneys on both sides are advocating for their clients. So the court sees this as an additional resource. What is interesting and I think really helpful about this is the investigators are now required to keep on going back out. And so if a conservatorship is established, the investigators have to keep on going back out at certain time intervals and do an investigation to report back to the court on whether the conservatorship is still needed. And again, this is in direct response to the Brittany case, because what you had in that case was a conservatorship who was established for someone at a time when she probably was having some issues, but that doesn't mean that she got better and things changed over time. But the problem with conservatorships is they're basically indefinite. And once one is established, it's very hard to get out of one, as we saw with her. So now with the new court investigator rules, so to say, the investigators are required to go out there annually and report back to the court on whether the conservatorship is still needed. So, and then the court actually is required to look at whether the conservatorship should be dismissed or whether it should be modified to be less restrictive. So this is really helpful, I think, because as you guys know, the courts are very slow to process things. I have a case right now where the temporary conservatee, my client, has been in a temporary conservatorship for a year. And we're still litigating on whether there should be a permanent conservatorship. This could go on for years because the courts are backed up. So now I'm able to argue in that case, well, he's been in temporary for a year. They haven't even established a permanent, but regardless, the investigator needs to go back out there now and see if this is still needed. And I didn't have that in my pocket before. So that is a really helpful development too. There are lots of other provisions of this law. There are lots of presentations going on right now, going over the new law throughout the state. I encourage you guys to attend. It's really interesting and a hot topic. And I can't go through everything right now, but those are the two important points that I wanted to make. And that's it. So thank you all very much.
Thanks so much, Katie, and thanks to the rest of the Hot Topic Lady team, Roberta Robinson of Robinson and Wilson, and Kristen Shepard of Goodwin Brown. They take turns in dealing with what's cooking. Just a final bid on upcoming meetings. April 5th, we've got Kristen Caverly and Lisa Roper of Henderson Caverly on death during divorce, the impact on spousal property rights. May, we have a presentation by our Planning for Real Estate series folks that we'll be fine tuning and coming up with the title as far as that goes. June, we have Wendy Goff, an ACTEC fellow of Stoll Reeves in Seattle. She's going to present in one of her areas of passion, the challenges of drafting for beneficiaries with mental health and addiction issues, all of which we all bump into. So she has a lot of insights on that, as well as the words that go into the drafting documents. Thrilled to have today Carolyn Taylor of Weatherly Asset Management LP and Will Beamer of Dowling and Yahnke, who are going to be presenting on navigating past, present, and future, investment themes and planning for 2022. The central bank tightrope, digital revolutions, real returns and dividends, and durable growth. Carolyn is the president and founding partner with Weatherly Asset Management in Del Mar. She's a majority owner of the partnership and is personally and professionally committed to providing comprehensive, high-quality investment management services to the clients at Weatherly. with over 39 years of portfolio management experience in high net worth individuals and institutional clients. Carolyn offers a wealth of investment expertise to Weatherly Asset Management's clients. Under Carolyn's leadership and strategic vision, Weatherly focuses on creating the ideal client experience and improving clients' world through problem solving, impact and change on the business, family, and community. She leads the Weatherly team by design in the industry for focusing on perpetual innovation, technology, mentoring, and human capital development. Carolyn's a founding member of the National Advisors Trust Company, an advisor-owned trust company with assets of 8.9 billion as of December of 2020. She's been on a number of committees in the Seattle Foundation. She's an engineer by training, having received her BS and BA from Stanford, but moved over into the investment banking world and managing investments, and has been doing that for many years since. She's she's part of the Vistage Leadership Program through the Stanford Graduate School of Business. She's an affiliate member of the Chartered Financial Analyst Society of San Diego, and is many awards and accomplishments that showed up in your meeting announcement. Certainly take a look at those. Worth Magazine's top financial advisors list, 5-star best personal wealth manager award for many years, Women of the Year for the San Diego Magazine finalists over many years, and many other accomplishments. In the meeting announcement, you have her contact information. So certainly reach out to her if you have any questions or information that you need for Weatherly or her. Will Beamer, and it's Will, not Bill. CFA, CFP. He's President, Chief Investment Officer, and Principal of Dowling and Yahnke. Will joined Dowling and Yahnke in 2002 and became a principal of the firm in 2007. In addition to advising clients, Will serves as the Chief Investment Officer, overseeing all investments and trading related operations. In 2013, Will was named president of the firm. He holds the designations of Chartered Financial Analyst, CFA, and Certified Financial Planner, CFP designations, and has quite a bit of a varied experience looking back over the years with Bain and Company, a management consulting firm in Boston. And before that, he was in the Navy, where he was a surface warfare officer on a Spruance class destroyer. So without any further ado, Carolyn and Will.
All right. Well, next time we'll have to remind Bill that the bios could be a little bit shorter, but we'll go from there and let you guys read that. But good morning, everyone here and in Zoom land. We really appreciate you tuning in for today, whether you're here in person or not. When I first want to thank Bill Super for inviting me to create a panel, which became Will Beamer and I. And we also appreciate the fact that JCF has sponsored throughout the pandemic so many presentations, both online and in person, because they've been pretty incredible. With that being said, no good fiduciary can give you a forecast without sort of looking past, present, and future. So what Will and I hope to do this morning is talk a little bit about where we've been each, where we're going, and where we're headed, but really focus down in, and you'll have to excuse our format. We decided to do more of a Q&A session, so you don't need to flip through the slides, but we're going to drill down more on asset allocation, inflation and monetary policy, and what we do for planning and investments for clients and how that really plays out. to talk about where we've been, you have to look at the past, and we've certainly dialed back to March 2020 when the world shut down. Global banks around the world decreased interest rates, fiscal policy infused money into the system. Many businesses were able to go remote. Other businesses had to shut down because of the sector they were in. And we saw a different approach than what we saw in 2008. That liquidity caused interest rates to go down. We've been in a 40-year bull market for bonds, and stock prices quickly recovered after a fairly short period of time. If you look back a little bit further than that, we've had 10 years of a bull market. So if I flip to the next page, we can sort of look at the last 10 years have been extremely lucrative for stocks. And it's great because I am from Weatherly and I'm speaking to a Dowling and Yahnke chart, but that's all great because we all use the same information when it comes to this, but really puts it in perspective. Where have we been and where do we think we're headed? It's not all about stocks. It's about where are interest rates? How are stocks priced? How can earnings be created from different companies? And where will we head from here? When we got into 2021, we saw a little bit different change in markets. There was, instead of the high-tech stocks or the FANG stocks or things along those lines doing extremely well, we saw a little bit shift as the world started to reopen into some of the more diversified names, maybe some dividend stocks, maybe some growth stocks still, but in a wider variety of sectors, and they weren't dominating the indices. As we continue into the fall this year, we've seen the Federal Reserve pivot, which we'll talk about quite a bit later in the presentation, and focus and remove some of their transitory inflation language and pivot to decreasing the bond buying that they did to infuse liquidity, then pivot even more to say that there may be 3 or 4 interest rate rises as early as March of this year. That has caused some volatility in January. We can drill down on that further in the presentation, but many words that people were less aware of. We've seen great increases in productivity during the pandemic. We've seen huge leaps forward in technology. We've seen supply chain issues really go to the boardroom, to CFO, and not just the IT level, and really having to organize that from a local and globalized level. So there's a lot of exciting things going on in the world right now, and we're looking for trends and how to best invest that moving forward.
Well, I'll give my kind of 5-minute intro as well. And I want to echo what Carolyn said about thanks to Bill Super for always doing a great job of organizing this event, and the folks at Loma Santa Fe and JCF as well. So really appreciate being able to be here in person, and hello to everybody on Zoom. Just to build on a few things that Carolyn said, I would just reiterate that this really has been a pretty amazing 12, 13 years in the equity markets in particular. You think back to March of 2009 when we were in the depths of the financial crisis, and the S&P was trading at something like 670, and today it's at 4,500. So we've seen about almost a 7x increase in large cap US stocks, and other asset classes have done in the stock market have done it well in addition, but the S&P has sort of led the way. And the other thing that I find pretty amazing is, I mean, COVID, if you look at this chart, or I think it's the, if you go to slide 4, the next slide, this just shows 2021. So, it wasn't, I won't try and say it was a fun month in, the spring of late winter of 2020. But it was very short-lived in terms of the decline in the stock market. That so-called bear market lasted all of 33 days, which I think the only one that was sort of in that same vicinity was if you go all the way back to 1987, when we obviously had, the 20 or 25% decline in a single day but the market actually ended positive that year. So, really, COVID ended up just being kind of a blip as far as the stock market was concerned. I agree with Carolyn completely. I think we're really at a turning point now for the financial markets. And I think it started in 2021. Last year, the S&P was up 27, 28%. But if you kind of look under the hood, it was pretty turbulent. There were a huge number of stocks that at some point during the year were off 30, 40, 50% from their highs during 2021. So trying to predict on a month-to-month basis which sector of the market was going to be the good performer was a really, really difficult exercise. There was just a lot of turbulence if you looked underneath. We're now seeing, as of sort of early November, Federal Reserve that has really changed its tune. We have been in a very accommodative phase for really the better part of 13 years now, with some kind of notable exceptions along the way. And, I found it rather amusing when, Jerome Powell decided it was time to sort of relegate the term transitory to the dust heap of history, because a lot of people had already kind of come to that conclusion. So, and we'll talk more about inflation in a bit. But I think that's really what the market's grappling with as we've started 2022 is when we move into a period of time where interest rates certainly look like they're going to be going up, what does that mean for individual asset classes? And at least so far in 2022, it hasn't been good news for growth companies with no earnings, a lot of the technology companies, a lot of the so-called stay-at-home stocks, think about Peloton or Netflix have had some real issues lately, at least maybe not the companies, but the stocks themselves. And it's really been much more an emphasis on quality and cash flow. And are these companies actually making money? And those are the stocks that maybe haven't gone up, but have at least held up much better so far this year. And then I think longer term, and we'll touch on this a little bit more maybe in the planning section. I think returns, if I'm not going to predict what the market's going to do in 2022. I don't have the faintest idea, but if you ask me, over the next 10 or 15 years, are returns likely to be higher or lower or the same as they've been the last 10 or 15 years? I feel pretty strongly that they're going to be lower. And I think that's true across bonds. I think that's true across equities. And that has some pretty major implications for planning and the conversations we have with our clients. We have, I know I can think of a number of clients in my own mind who, I don't want to say they've been bailed out by the good returns, but they have certainly enjoyed them. And, going forward, if someone's retiring into a market with a 60-40 portfolio, which we'll talk about in a second, and they're only going to be able to get a 4 or 5% annualized return from that portfolio, and inflation maybe is going to be higher. Are they disciplined enough on the spending front to sort of weather that period of time during maybe the first decade, maybe 2 decades of their retirement? So a lot to talk about there, but let's get into it. So Carolyn, we're going to kick off with a section on asset allocation and individual asset classes, but maybe just give us kind of your high level view on, remind us why asset allocation is important in the first place.
Great. Thanks, Will. So let's turn to page 10 or chart 10. This looks like a periodic table to everyone, and you don't need to see all the boxes and what's written there to understand it. It really looks at annually what has been the top performer at the top, whether it's growth, value, real estate, fixed income, what has been the bottom performer, and over a period of time on the far right, how has a diversified portfolio played out for the real returns here? And one thing I will say is, you can see the colors jump from the bottom to the top and the top to the bottom and someplace in the middle. And for those of you that are investors or guide clients in this area, certainly large cap growth stocks, as we both talked about, did very well early in the pandemic. It flipped last year a little bit to more value stocks. And then this year, we've actually seen negative returns on bonds. So yes, you can lose money on bonds. But the key to this page is really saying you can move within different sectors or different areas of the market and capture what is undervalued. And that's what we see a lot of people doing with their portfolios during 2022 as the interest rate and the yield curve have gone up. So what I'd like to pose to Will is a 60-40 portfolio dead? And do I care about alternative assets?
I have a very cynical view on this. So when I don't, for those that follow the sort of financial media, it seems like just about every week there's an article that says the kind of classical traditional 60% stock, 40% bond portfolio is a thing of the past. And you know, we should all be allocating a sizable chunk of our portfolio to alternative assets. And usually when you dig into it a little bit, those articles are written by people who are selling alternative assets. So it doesn't necessarily invalidate the argument, but I always like to understand sort of who's asking the question in the first place. And I think it's also, you know, I've been hearing this for quite a while, and the 60-40 portfolio, at least up until, you know, today, has held up pretty well. That, you know, you could go to Vanguard, you could put some money in Vanguard Total Stock Market, Vanguard Total International, and Vanguard Total Bond Market, and you've maybe rebalanced that once a year, and you've done pretty darn well over the last, you know, again, 12, 13 years. Looking forward, it's a tricky picture. There's no doubt about it. When you've got a 10-year Treasury bond yielding 1.7, 1.8%, and at least right now, you've got inflation running at 5 or 6%. So you're effectively, you know, you've got an effective real yield on your bonds of, you know, call it -3, -4%. That's obviously not a real attractive investment proposition. So I certainly understand why the question's being asked. I do think, you know, the attractiveness of alternative investments really depends to a large degree on a number of factors, but really the profile of the end investor, him or herself. So I think for, you know, some of our smaller clients, building out an effective alternative allocation is a pretty tough thing to do. You know, and I'll just cite some of the factors: getting access to the best managers, generally speaking, the tax inefficiency of alternative investments, the higher fees of alternative investments, and for smaller investors, just getting adequate diversification across managers. So are you going to use a fund of funds format, which introduces a lot more layers of cost? Are you going to concentrate and just pick one or two, you know, maybe a private equity manager and a real estate manager or a couple of hedge funds? Well, often these funds have minimums. And so it's, you know, now for much larger, you know, clients, once you get up into the 20, 30, $50 million range, those issues may start to be a little bit easier to deal with. So I'm not unequivocally opposed to alternative investments, but I'm a little skeptical of why they're being pushed so hard. And the last thing I'd say is there's nothing truly magical about alternative investments. Interest rates are not higher in the land of alternative investments. Interest rates are like gravity. They apply to all of us. And so the main reason, in my view, you should expect a higher return from illiquid private alternative investments is the illiquidity premium, that you are tying your money up for a longer period of time. And again, back to the investor profile, some clients can afford to do that and others can't. So again, not a bit of a nuanced view. I'm not necessarily opposed to it, but I think the reports of the death of the 60-40 portfolio are perhaps premature.
So let's talk a little bit about the US dollar. The US dollar has been the place to be for quite a long period of time. Is that shifting? Is that something you have to be concerned about in a portfolio? should you be based internationally? If you look at the next chart, you can sort of see international equities have a role. They can certainly play a part in the portfolio, but the US dollar has been extraordinarily strong during this period of time. And there's always going to be an ebb and flow. If you can play that ebb and flow, that's great, because whether or not you're a diversified international company or you're an overseas company, and is that a role you're going to do with emerging markets, developed markets? Do you have currency exposure? Do you not have currency exposure? Do you hedge that? And what we see right now is that we're shifting to a more diversified portfolio. The US dollar has been extraordinarily strong. There are some opportunities overseas in Europe, and we see that that is something that will play out in portfolios over the next year or two, just like diversification started to broaden during 2021 with growth and value stocks. We have been looking at other areas to say, where are there opportunities? Is it the alternatives? Is it the IPO market? You know, many of those things that make front page of the news, but they don't actually have a place in most client portfolios. So that's where we start to drill down and say, is this client over that $10 million mark, the $20 million mark? Do they need to do it with an ETF or a mutual fund? What is appropriate here? And how can we build it out? And where is it within the portfolio? Is it a Roth account? Is it an IRA? Is it a trust account? And how diversified are they within that? As you probably run into, a lot of clients have one particular company stock, they work for it, or that has appreciated to be an extraordinary amount in the portfolio. So what we're looking at is, where can we shave portfolio positions that have done well and put them into some of the newer sectors? With that being said, I would say FANG stocks had their place, so do small cap, so do value, so do growth, but being able to build that throughout a portfolio is key for the asset allocation success. And a straight index portfolio is not going to be what it has in the past. I would agree with Will in that projected returns moving forward, when we do planning for clients, we use a 6 or 7% rate of return, and that's way different than what we're seeing on these historical charts over the last 10 years, over the last 3 years. That's so that the clients have a high likelihood of reaching those targets, right? Even during volatile markets as we had in January. So Will, do you think we should turn to the next section, a little bit on inflation and monetary policy?
Sure, let's do it.
Let's see, talk about some baskets of inflation and why we care as an investor.
Yeah, I think, you know, the why we care, maybe we can go to slide 20. You know, the why we care is probably the most important thing. And that's because we all spend dollars, right? And so if inflation goes up another 5% this year, you know, what costs you $1 today is going to cost you $1.05 a year from now. And that may not sound that bad, but when you start to compound this over, you know, a 5, 10, 20 year period of time, it starts to be pretty problematic. So, you know, I think we've had a long period of time where inflation has sort of run at, you know, 1.5–2%. I have a personal view that, you know, obviously when you have inflation like we haven't seen in 30 or 40 years, it makes headlines and it starts to freak people out. I think there are some real reasons to be a little bit skeptical that the inflation that we're seeing today in that 5 to 6% range is going to persist. So I'm not going to fall into the Jerome Powell trap of calling it transitory. But when I always like to go back and say, what's the market actually telling us right now? And if you look at, I won't go into the gory details on this, it gets a little technical, but there's a measure in the market called a break-even inflation rate. So you're effectively comparing the yields on Treasury inflation-protected securities to straight US Treasury bonds. And whether you look at the 5-year break-even rate, the 10-year break-even rate, or the 30-year break-even rate, Right now, it's telling you that inflation over those timeframes is going to be somewhere in the 2.5% to 3% range. Certainly higher than it has been, but nowhere near the sort of 5, 6, 7% that we've seen over the course of the last year. So I personally, one thing I talk about a little bit with clients is be a little bit careful in overprotecting yourself or going really hard on hedging your portfolio against inflation, because that can lead you to some decisions that may introduce other risks into your portfolio. So for example, I get asked quite a bit right now, should we have more in tips? Well, having more in tips would have been a great idea about 18 months ago because they had a great year last year. Now for tips to perform well going forward, we would have to have unexpected inflation above and beyond what we're currently seeing. So that could happen, but it's a higher hurdle than simply saying, oh, well, inflation's high, we should have more tips. So I don't know if you want to build on that a little bit, Carolyn.
Yeah, I was going to say maybe we go to page 16 and page 17, because if you look at commodity prices and things along those lines, look at oil went to zero in March of 2020 and trading in the 80s today. It's been the best performer over the last couple of months. So, things do flip. It goes back to that asset allocation chart, but these are different price changes in different commodities. And many times when people are concerned about inflation, if you're a company CEO, you might be hedging some of the positions that you need to have those raw materials in place. If you're a farmer, the same thing. If you're a business that's investing for clients, we're looking at those same opportunities. Where can we invest? What is continuing to grow? And what is a trend that we can capture for the client portfolio? And what we see with that ebb and flow is that many of the things, such as lumber prices that skyrocketed, giving the demand for housing and whatnot, came down and subsided. Then they went back up, they've subsided. The same thing is true there. Once again, with inflation, people are concerned about protecting their principal, being able to hire workers, being able to get inventory to sell, a number of different aspects of it. If you have a fixed wage, it's going to make a huge difference. If you recall, during the beginning of the pandemic, I believe the unemployment rate was 14.9%. It's now closer to 3.9%. So we do have structural issues with employment, but if you're on a fixed wage, which probably not too many of you in the room here are, but if you are, this inflation is key because your rent might have gone up, right? And your wages may be less so. Social Security went up over 5% this year for those of the people that we do planning for. That was a big kick for them. But what I will say, if you go to the page 17, a lot of times people not only ask about tips, as Will said, but looking at what has gold done or what can it do in the portfolio. And if you sort of look at this chart, you can see that gold is a place in the portfolio, but it hasn't offered returns above that of equity markets, of bonds, of many things. So there's other ways to protect yourself when it comes to inflation. And actually, surprisingly enough, sometimes it's equities itself. And you'll have to help me with the page, but it's on one of the other pages. But equities have been one of the higher performing asset classes during inflationary periods. So when you talk about the 60-40 portfolio, or you talk about alternative assets, looking at some of the traditional equities have actually given you the return you need to retain principal. So has real estate. So I'm going to turn it over to Will and ask him some questions about what's the dual mandate of the Fed and why do we care?
So the dual mandate is really that the Fed has been charged with maintaining so-called full employment, and then also with keeping inflation under control. And those are obviously, they're not only, it's not only a dual mandate, but it's often a mandate that's in opposition to one another, right? Because if you run the economy too hot and we have, we sort of go beyond full inflation, you introduce inflationary forces into the economy. So when we look at it right now, as Carolyn said, you've got unemployment at roughly 4%. I can't remember the exact numbers that I heard yesterday, but we've got something like 12 million job openings in the US and only 7 million unemployed workers. So, that's a big, we simply have had a lot of people fall out of the labor force. So when we think about what's driving inflation right now, so we think of sort of classic inflation as being demand driven, that people are buying up goods and services and driving up those prices. And a lot of what we're seeing right now is actually supply driven. So not enough workers, not enough semiconductors, we think about all the shortages, we think about all the, a few months ago, they were talking about, I don't actually know how big a problem it is right now, but all the ships sitting off the port of Long Beach and Los Angeles that couldn't get into port. So not enough, dock workers and trucks and rail cars to unload the goods. And so you start having shortages, and that's what has really been kind of driving up the prices. And so, you kind of think to yourself, does the Fed jacking up interest rates really solve that problem? And I think we don't know yet. But I don't think that's going to make the Port of Los Angeles suddenly work 24 hours because interest rates are higher, right? So, but I am optimistic that some of these supply shortages and supply chain issues will start to sort themselves out over the coming months. The question is, in the meantime, is the Fed going to sort of overshoot on being very aggressive about inflation, and when that's not really what's causing the problem in the first place?
So to put it in perspective, we're sort of on a precipice right now, right? We've got the Fed on one hand trying to contain inflation or price control, and then we've got demand on the other side that is both demand and supply chain related. So it's an interesting time in history. I was listening to a supply chain barons webinar yesterday. Fascinating for those of you who love this business. But in any event, Honeywell, Intel CEO and supply chain experts were speaking. And part of it is that we're at a point in history when we have more data than ever in history. We have more need for chips in everything from refrigerators to lawnmowers to cars to work from home. And do we need all that? Well, maybe not. But, in any event, that's where we are. So no one foresaw the need for that sort of thing. No one foresaw when the Fed lowered interest rates and the world deurbanized that everyone was going to go out and buy a house or lend money to their adult children's to do so, given the historical opportunity for interest rates. So some of that demand and some of it's supply related. And I agree with Will that much of what we're seeing now is the ebb and flow of that demand shifting to other areas. Will business travel resume to the level it was, or will you stay on Zoom? Will you be pickier about what you do on Zoom or GoToMeeting or whatever you use? Or will you do it with your clients both ways? Multiple families around the globe that we work with want to beam into a meeting. One might be in the office, and we were just saying that we invested in technology to make sure that we can accommodate that. So the world is changing and the productivity is changing, and there's a lot of great things going on. So capturing those trends in an investment portfolio is what we want to do. So maybe with that.
Actually, I was going to just building on the data theme a little bit. Brandon, could you flip back to slide 6?
See, we just put in a lot of charts and we're just going with the questions.
I find this kind of data really fascinating. I mean, we 10, 15, 20 years ago, we didn't have this kind of data, right? The sort of real-time high frequency data. And to me, you think back to sort of March and April of 2020, and you look at dining and TSA passenger traffic, both of those went to zero, and which is kind of hard to, I shouldn't say it's hard to remember, but it's weird to think about, right? That whether it was dining out or going to movie theaters or getting on airplanes, it just stopped for a couple of months. And now it's kind of bounced around, and you can see over at the tail end, that's obviously the impact of Omicron, that we've had a bit of a drop off again. But, to Carolyn's point, the TSA traffic is still down 17%, largely driven by, I think roughly a 50 or 60% decrease in business travel. But spending, consumer debit and credit transactions is now well above where it was at the beginning of the pandemic. And hotels have bounced back, although they're not quite all the way back. So if I always find this kind of stuff really interesting to look at, and I know they use Open Table and obviously TSA, and there's a number of different sources for it. What's next?
Let's go to planning. As any good fiduciary, we not only do investments for clients, we do planning. And the last couple of years have been an incredible opportunity. Incredible. I can't tell you how many conversations we've had with clients, with their CPAs, with their attorneys to say, okay, with this great equity growth, these low interest rates, where are you now given your assets? Where are you headed from here? Where's your business? And what do you need to do in the future, whether or not there's proposed tax changes or no proposed tax changes? We also had the fact that clients didn't have to take their minimum required distribution. How could they take advantage of that opportunity? And so if we can turn to page 25, this is a good cheat sheet for what is the 2022 federal tax rates, contributions to 401ks, and the estate tax limits. So I wanted Will and I to spend some time each talking about a particular client situation that we did this planning, not only the investments, but the planning with throughout the last year or two. So Will? I can't tell you how many client conversations our team has had, and they've been with clients, as I said, that have been extraordinarily fortunate, not only with their assets, they've grown during this time frame above the expected return, right? Not only because they have a good advisor, but because equity returns have been there, bond returns have been there, and real estate returns have been there, and they've had low interest rates. Same with their business, incredible opportunities. But then they sit there and they say, okay, you've done a financial plan for me. Maybe we have more wealth than we can ever use during our lifetime. And lifetime is another thing, because we plan for people into their late 90s. And even though they don't want to plan for that area of their life, they need to. So part of what was changed during the pandemic is instead of taking an IRA distribution early at 70 and a half, you could wait until 72. Those are easy things to do with clients, but it meant their adjusted gross income dropped that year. And how could they take advantage of that in other areas with partial Roth conversions? So we work with a client that's up in San Clemente area, husband and wife, concentrated portfolio position, balanced portfolios, many trusts, have already gifted homes to their adult kids, have 529 set up for their grandkids, have irrevocable trusts that they've set up for Gen 2. But what you saw them doing is saying, wow, we've amassed a huge fortune here and we're very fortunate. What can we do to plan? And even if the estate tax limits are not changed, or even if federal tax rates don't go up, how do I want to push this out during, they say, with a warm hand instead of a cold? How can the next generation, how can my community benefit from these things? So we set up another irrevocable trust. We worked with their adult kids on how do we actually manage a play portfolio. We worked with those clients on creating a large donor advised fund. We worked with and putting some of that appreciated stock in there, being able to liquidate it there with no capital gains and distribute it to the community during great need. So I would say these are step 1 and 2. These are not conversations I mentioned to Bill earlier this morning that you have with a client one time or with their attorney or CPA on the line. It's getting them accustomed to our language. It's talking about their specific situation and getting them to move the needle. Maybe they're not super philanthropic, but maybe they didn't know what they had as an opportunity to keep and give and teach their kids and grandkids about philanthropy and not about how much money they're going to inherit. So there's some incredible opportunities and very appreciative clients during this time. They have access to healthcare, they have access to credit, they have extraordinary returns, but to do that planning with the appropriate CPA and attorney on the line and move that needle to make sure they're set up for the future it's very rewarding. So, Will?
Yeah, a lot of overlapping themes. Maybe I'll focus on, we've helped a number of clients who have been fortunate enough to, maybe retire in, say, their early 60s. Obviously, as they contemplate that, they pretty quickly want to know, okay, where's the money going to come from? What does the plan look like? And, there are a lot of aspects to that, but there can be a ton of really attractive planning opportunities for that profile of client. So often the first step, if they're able to fund their retirement for the first 10 or so years, is to defer their Social Security income until age 70. And that means that, outside of portfolio income, they're probably going to have very little taxable income. We then, as Carolyn sort of suggested, you start looking at things like Roth conversions. Can they get money out of their IRAs at a 15-20% federal tax rate? If they can do that and they're charitably inclined and they've got a sort of seasoned investment portfolio, you start looking at the Amazon stock in their portfolio or the Netflix stock. Well, until recently. This was all last year, exactly. And open up a donor advised fund. And maybe they want to involve their kids in the conversations around the donor advised fund and what their charitable priorities are. So it sort of leads from one thing to another. And it's only limited by, sort of our imagination to help them and their sort of willingness to put a little bit of time and effort into it, because obviously you're not going to have these in-depth family conversations if they're not ready to do that. But a lot of great stuff that you can do. And then, we've probably, and, Brett and Mike are sitting here, two of my partners. We went back 5 or 7 years, we probably didn't do that much in the way of qualified charitable distributions from IRAs. We do a ton of them now. So for clients that are at the age where they're required to take money out of their IRA and they're charitably inclined, the ability to give away up to $100,000 of that RMD each year is a really powerful thing and enormously tax efficient. So that's often the first place that we'll look on the charitable side.
Well, keep in mind, you don't have to give away the 100,000. You can even start with the 10s and 20s and 30s and 40s, and it doesn't flow through your adjusted gross income. So it's a great tool. I will say it was maybe a nightmare for investment advisors because keeping track of that for clients was a new thing. It was used predominantly by those 70 and a half in one day, so that's a great opportunity. You don't have to wait till that 72 age for required distribution. So where's the state ceiling going to go? Where are taxes going to go? We're not here to forecast that today. We're not here to forecast markets. But we will say that, it's still set to sunset in 2025. So with no action, we potentially go down to 5 to 6 million. So doing some of this planning for clients and shifting either from their IRA bucket to the community, from their IRA bucket to their Roth with lower tax brackets, from their trust portfolio to an irrevocable trust, maybe for the next generation or something along those lines. We have clients that have 3 or 4 irrevocable trusts. So it's a real thing and it's happening out there and it's moving money to the next generation. And so some of those proposals are out there to guard that. We haven't spent much time talking about real estate, but we've had also a huge shift in that sector as far as ownership with intrafamily loans at the rates that are allowed by law, whether it's from the family to another family member, could be generation up, generation down. instead of a reverse mortgage or them qualifying as newer people in the workforce. It's also a good opportunity for some lower income for a family. So there's incredible planning opportunities still this year during the pandemic, and we look forward to those conversations, but I'll turn it back to Will.
Yeah, I was just gonna, one last kind of comment on that. You know, I think it was as recently as 2 or 3 months ago, I was in this room and there was a presentation, don't remember exactly who it was, but we were hearing about all the tax changes that were likely to be coming. And it's pretty amazing to me that none of those have manifested themselves. And so, you know, we all like to stay ahead of the curve and know what's coming down the road, but it's a little bit hard right now because with the situation in Washington. But you know, I'll thank my lucky stars. You know, I'm happy with no changes and still the ability to do things like backdoor Roth contributions and some of the other planning opportunities that Carolyn alluded to. But we'll have to keep paying attention and see what happens.
So one thing that we haven't talked about, and I'm sure it'll come up in the Q&A, which we can open up for fairly shortly, is where do we stand on virtual currencies? Where do we stand on SPACs? You hear a lot in the press about this, but just to sort of outline it, we love blockchain technology. You know, it's a ledger system that basically accounts and is an open architecture that anyone can see what is passing from A to B on that ledger. And it's very efficient for many companies that have captured that within their supply chain management and other aspects of it. There are a number of virtual currencies that people hear about all the time and follow. We are certainly big fans of moneyless payments, and you can talk about credit cards, you can talk about things like PayPal, Venmo, which are really the same thing, Venmo, et cetera. But you're really talking about no longer checks, no longer cash, even in India buying up currency so that they would create bank accounts and have more virtual payments. So, you know, we are in an era of technology, whether it's the data we're talking about, the supply chain management, the ability for some businesses to continue to work from home and have hybrid workforces, robotics, AI. Technology is very, very exciting. It can be threatening, but it can be very exciting when it's utilized right. And I would say virtual currencies are here to stay. Doesn't mean that we're investing in them, but the technology behind the virtual currencies we believe in, and we'll have more of that moneyless payment captured in the virtual area moving forward. But Will, you want to make any comments?
Yeah, I look at the whole cryptocurrency landscape, and I'm by no means an expert on it, but I sort of liken it to the .com phase back in sort of 98 to 2000. And there were winners that emerged from that. But I have a hard time believing that the world really needs 500 or 1,000 digital coins and currencies. So I suspect, and we may already be seeing the beginning of this, that there's going to be a pretty enormous shakeout. I'm sure Bitcoin will be a survivor. I suspect Ethereum will be a survivor, and I don't know enough about it beyond that to tell you which other ones will survive. I think, you know, we could have a whole session on cryptocurrency and Bitcoin. You know, there are some absolute benefits to it. I think for people that live around the world in countries that don't have stable currencies and can't use their country's currency as a store of value because of devaluation or whatever else political uncertainty might exist there, the ability to actually store it in some other currency it has value. On the flip side of it, you look at the ridiculous amount of energy that's consumed by the verification of you know, blockchain transactions, especially related to Bitcoin. And you know, it's hard to argue that Bitcoin's a real investment in environmental sustainability. So you know, somebody smarter than me is going to figure this all out. But I'd be real careful investing beyond, those two cryptocurrencies that I mentioned, and even investing in Bitcoin, which has gone from 60,000 down to 35,000 recently, has been a roller coaster.
So in summary, from my perspective, we've looked a little bit at the past. We're living in the present and we're headed into the future. There's some great trends that we will continue with, that equities have outperformed inflation over time. A diversified portfolio can minimize risk. There's some great planning opportunities in the future. The interest rates are going up. We have a historically flat yield curve right now, which really means that does it pay you to go further out? Are people going to borrow short term or long term? Are they going to lose principal as interest rates go up and inflation goes up? So there's a lot to manage here. And I want to say not just managing money, but managing planning opportunities. And I would say we're at a turning point. This year will be very important. All eyes are on the Fed. All eyes are on interest rates, and will the supply chain demand and inflationary pressures caused during the pandemic and with the infusion of capital into the system, whether it was fiscal or monetary policy, how is that going to play out? How will it play out in the portfolio? How will it play out in people that are resuming back to work? Will women come back to work? Will those baby boomers that retired come back to work and shrink that gap that Will was talking about? One reason we have been able to continue to grow and see earnings grow is due to productivity, due to increases in technology. So these are huge advances, and we see a number of those advances continuing to play out in other areas in science and biotechnology, and even spread internationally. So we're really looking forward to this year and hoping that the Fed and central banks around the globe can walk that tightrope, and that the earnings still come out ahead of expectations as they have this quarter so far. So it's been a pleasure to be here today, and I'll turn it over to Will to summarize anything else.
Should we take some questions?
Great. Isn't that what we were doing the whole time?
From people other than the two of us.
Okay.
I'll repeat the question, then Carolyn can answer it. So the question was around Russia and Putin, and if Putin does decide to actually invade Ukraine, what are the short and long-term impacts on financial markets?
Yeah, so if you look at history, which is where I'm going to go, is you always got to look at history, because we've had inflection points like this over many periods of years, and it can be a detrimental thing. It will be a cost, a human cost, a manufacturing cost, a diversion from economic recovery that we wouldn't want, plus a disruption in the recovery process that we've been in. It could be a short-term inflection. I don't think so, but it will be a blip in the system when you look back on history. Certainly impactful at the time and for those involved, but we don't want to be on this precipice that we're talking about and decrease the productivity, the concern about inflation and other aspects there with the diversion there.
Yeah, I'm not sure I have a ton to add, but I think back to Saddam Hussein invading Kuwait in August of 1990. And I believe there was a short-term, again, kind of a short-term blip in the market, but the market recovered pretty quickly. Would this play out that way, or would this somehow escalate into a full-blown war in Europe? I think we all really hope that does not happen. I think, on the opposite side, not standing up to Putin has its own set of risks. And the one I probably worry about the most there is emboldening China to, take action against Taiwan. So, which, we could go in circles on this thing, because then that, I was reading something about if that happens, You think we've seen a semiconductor shortage so far? Just wait till China invades Taiwan, right? So, I think, and I obviously do come from somewhat of a military background, but I do think that there's an opportunity here to really stand up to aggression, and hopefully that deters the aggression. But I think there are some real risks to not doing that.
Any other questions?
What do you suggest as a fixed what replaces that? It's correlate cost.
The question, just for the Zoom audience, is if you're a 40s or 50-year-old individual and you're looking to maybe retire, what do you look for an alternative to fixed income given low interest rates? Is that okay? I would say if you're in your 40s and your 50s and you're retiring, that probably you need a financial plan done to make sure you can retire. And two, you need to see if your portfolio is allocated appropriately for the returns that are needed and the income that you're going to get from various sources, whether it's Social Security, real estate, pensions, IRAs, et cetera. You have a long gap period in which you have to earn some income. But do you need to earn income, or do you need to receive total return, which is change in principal and income? Right now the game in fixed income is short-term, high quality, and that's better than, in cash, right? But anything out on the yield curve, if we go up from where we are right now, which we think we will, you're going to have a decline in principal. So I think if you need to be or want to be that person more conservative, they can look at some of the dividend-oriented stocks, and I want to mention some of them, but let's say there's a handful of companies that are still paying high dividends. They're in particular sectors. We talked a little bit about oil before. They're in other sectors that are consumer durables. So looking at that to kind of balance the portfolio, it's probably above your interest rate return unless you're going into emerging markets or junk, which I wouldn't recommend.
Yeah, I think it's critically important to understand sort of how much risk you're willing to take on to substitute for that fixed income allocation, right? Or do you want to change the composition of the fixed income? So, right, there are two primary ways to take risk in the bond market. One is to extend duration and go out, 10, 15, 20, 30 years versus kind of 1 to 5 year. And you might get a modestly higher yield by doing that, or you can take credit risk and buy corporates instead of governments, or buy high yield instead of investment grade corporates. That's worked reasonably well for the last few years. As soon as we go into a recession, you might regret that you did that, right? So, there are, I don't know if I said this earlier, there are no silver bullets, right? All fixed income, all equity investments are operating within this same world of low interest rates. So there's a part of me, and when I want to put on my sort of tough love hat, it's, look, this is the world we're in right now, and I don't want to see you take excess risk. You're just going to have to grin and bear it and spend less money for a little while. And that's just, people don't like to hear that very much, though. It's funny.
Corey, and one thing, they could probably get a good insurance policy that would pay some good dividends there, or rental property. But
the question was, do we see REITs as a substitute for fixed income? They certainly do. REITs are an interesting story. I mean, I like to go back to the .com period of time. Nobody liked REITs or seemed to have them in their portfolio. And in the aftermath of the .com bubble, in what everybody then called the lost decade, which was when the S&P basically had a 0% return for a 10-year period of time, REITs did fantastically well. And so it wasn't a lost decade if you were diversified, like the sort of quilt chart that we saw earlier. And if you had money in small cap stocks and foreign stocks and REITs, you didn't have a great decade, but you probably got a 4 to 5% annualized return. Today, REITs have run up quite a bit. And so REITs that used to pay, a REIT index that used to pay maybe a 6 to 7% dividend yield probably pays 2.5 to 3% dividend yield today. So, and they're, at the end of the day, REITs are stocks. And so they bounce around substantially, much more like the stock market than, like a bond fund that, yes, bonds have bad years, but a bad year for a bond index is down 1 to 3%, not down 30%. So we full disclosure, we put REITs in portfolios. We buy the indexes. So we think they serve a place in a portfolio, but I'd be careful to say, I'm going to take half my bond allocation and put that into REITs.
Think of all the money that's gone into real estate over this last 3 years in particular, and see how the prices have gone up. That low interest rate environment is still here, but it's less so, right? And as rents rise right now, landlords have control of that rent. There's less restrictions on that. And the whole REIT marketplace is still priced, I would say, ahead of itself at this point in time. So market timing in that area, once again, a portion of the portfolio.
Yeah, I think the only slight caveat I'd add is around international real estate, which did not perform nearly as well as US last year. So Vanguard's got a ETF VNQI that tracks international REITs. I don't know exactly what the yield is on that, but if you're looking to sort of be a little bit tactical on the REIT side, I think international perhaps looks a little more attractive right now than US.
We had one more question, then I think Bill, I see Bill checking his clock, so we'll go from there.
So we always do the looking ahead. How good either in the short run or in the long run? Talk about, how good are people?
All right. So the question for the Zoom audience is how this time of year people are doing a lot of predictions and the forward looking, how good are they at that prediction, and how does that play out moving forward? And is that okay? All right. I guess I would say both Will and I, when we talked about this talk, we said, oh, I've listened to Schwab, I've listened to Vanguard, a number of different things, because we also listen to outside opinions to say, where are we headed? What do we think? And what do we actually take from that? What morsel do we take from that? And I guess what I think you're going to find us both say is we're going to go back to the past again to say, okay, we may play the nuances of different sectors or adjust an asset allocation, but market timing has never worked. And if it does, those managers are out of business or they're not telling you the truth. But I will say that you can make adjustments in the portfolio to minimize risk. So if you are mostly in growth and you shift value as you see those valuations change, that's great. If you were in longer term bonds because you had a 40-year bull market and you shift to shorter term high quality or municipals, then that's been another opportunity to avoid principal decline. If you see the US dollar strength, maybe it's going away a bit or not as strong. There's opportunities with undervaluations overseas, so diversifying the portfolio there as well. If you talk about economic predictions, I would say, less so. But if you talk about portfolio predictions and sectors and yield curves and all these things that we've been talking about today, it's really the nuances. It's picking up dimes in front of a bulldozer. You're not trying to turn on and off the bulldozer every day or market time. You're really just trying to pick up those pennies and dimes and move the portfolio in the right direction with consistency to achieve a plan.
Yeah, I mean, I think Wall Street strategists are lousy at predicting what the market's going to do. I mean, they always have to, what's your S&P target for the end of the year? And they all cluster within sort of a 5 to 10% range. And almost every year, the market's markedly lower or markedly higher than their prediction. So I put, and I don't think Carolyn and I fell into that trap. Neither of us gave you our 1 year stock market prediction. But I agree with Carolyn that when you sort of look at long-term trends and you look at, as an example, how US large cap stocks, S&P 500 has, how well it's performed the last 13 years, how relatively poorly foreign stocks have performed, and to some extent, small cap stocks. And you look at the deltas in their valuation metrics today, that would suggest that at some point there will be a reversal. If you believe in mean reversion over the long run, I'm pretty sure people in international markets like to make money, I think, as much as Americans do, maybe not. But if that profit motive continues to exist, I would think that that valuation gap will close at some point. Now, valuation tends to be a really lousy market timing tool. So simply looking at valuation metrics and saying, oh, well, clearly small caps are going to do better this year, or international stocks are going to do better. It doesn't work that way. But over the more you open the aperture and you look at longer time horizons, 5, 10, 15 years, those trends do start to matter. And so, you just have to make sure clients aren't expecting immediate results and trust that you're doing the right thing in the long term.
One thing I'm going to add to that is when you look at those predictions, looking out over the longer term, people are going back to what Will said earlier, and that expected returns are expected to be lower. It doesn't matter what sector. It's really pretty consistently across the board. Don't plan on these above average returns, not only that you've seen in equities and bonds over the recent history.
On the other hand, the folks that have gone out on a limb and been super pessimistic have been wrong for a long time. So you look at like Jeremy Grantham at GMO in Boston. He's been predicting negative real returns for years now. I think he just came out with another prediction that the S&P is going to be down 55% this year or something like that. I sure hope he's wrong, but he's been wrong a lot. So
it's a good thing your business model isn't forecasted on
no
that.
thanks.
Right? Well, thank you, everyone, and appreciate Bill once again for asking us to do this. Look forward to a new year.
Thank you, Will. Thanks, Carolyn. So many insights, so many charts that we can peruse at our leisure. Thank you all for coming. Really appreciate your coming in person. Seems to be increasing, people a little more comfortable. Certainly in the networking world and developing professional relationships, being together really makes a difference. Certainly thank you to Katie Swafford, Kristen Shepard, and Roberta Robinson, who are handling the hot topics. And we'll see you on March 1st with Jenny Bratt and Sarah Pike. Paul Hines is our sponsor for that meeting. So we'll see you then. Thanks.